Hi, I'm Keith McCullough, and welcome back. We're going to jump right into a conversation about commodities. All right. Now, this morning I cited a book by a gentleman by the name of Green, which was written back in 2012. The book is called Mastery, and I think with Josh Crumb in particular, who I've known for a while, this would apply. Which is, again, to understand the craft, to do the job, you have to do the job, right? And you have to do it over and over and over and over again. You have to learn through all your mistakes. You have to try to innovate, fail fast, et cetera. You've done a lot. I mean, from your Goldman days to where we're sitting now. And one thing that you've been very consistent with is your process, your framework. And I think that that's maybe a good spot to start. First of all, David, welcome as well.
Glad to be back, Keith.
Yeah.
Thanks for being here in person.
It's good to be in person for the first time in years. So.
Yeah, I was joking that Crumb didn't get any shorter. He is also known as Caveman Crumb from back in the day when we had these during COVID. But maybe just start with that, because I think that when people look at commodities as an asset class, they're generally confused because of the volatility at a bare minimum. They're like, I can't believe this thing's going down so much. They wouldn't really complain when it's going up a lot if they're long it. Yeah. But let's just dig into your framework, and then we'll talk about specific commodities.
Yeah, sure. So again, thanks for having us back. A couple things I should say up front. We are in the volatility business, right? and actually, this is the first time we've been on since we've been launched. So we are a regulated exchange and clearinghouse with 9 different commodity products traded globally. So I probably will have to measure some of the outlook views. Again, right. We're in the scoreboard business, not the referee business or forecasting business. So need to mention that up front. But again, we also built this business over the last 6 years, expecting every one of the transitions that the world's seeing today. The transition where gas is really going to become the global commodity that matters, not oil. So if we think about the Plaza Accords or before that, it was really based on oil and OPEC's power in the world. And now gas is the major commodity. So we built our business around LNG, expecting that shift. Second, we see the changes in global currency and collateral, particularly in global derivative markets, changing, whether it's central banks or it's clearing houses. That's all kind of playing out, and then there's a technology component to moving that collateral around the world. So, I don't want to get super technical up front here, but I think it's important to understand that when we're talking about commodities and macro, when you say the oil price or you say energy, you really have to get into the specifics and the plumbing of what's actually happening in those commodity markets, in those collateral and volatility markets. So maybe Dave is actually might be better to explain a little bit of the particulars of why a commodity is very different than, say, interest rates or duration markets or securities.
Yep.
Yeah, and I think Josh touched on the big thing, which is when people go to the newspaper, go to the media, and they'll talk about oil. It's a very broad topic, right? But if you're buying a commodity futures, you're buying a specific type of oil in a specific place at a specific time. And when everything's working fine in the market, when there's not a lot of stress, you can kind of get away with saying, well, it's just oil. When there's a crisis, it matters a lot. And so I think what we've seen, really since COVID, right? Like you saw it in the gold market if you go back, the futures market being located in New York, the spot market in London. In good times, they're fairly well connected to each other. When you had COVID, they became disconnected. It became a big difference. It mattered a lot. More recently, when the market was anticipating the possibility of tariffs on gold, you saw a tremendous price spike in New York relative to London, a lot of gold being shipped overseas. Of course, now the tariffs have not been applied to gold, so that has to unwind. But when you look around the world now, especially with the tariffs being imposed, and this goes back a while, right? What we've seen over the past few years is people care much more about where their commodity comes from.
Yep.
You've seen the decommoditization of commodities. It's not fungible the way it used to be. And so it really matters that you have, and you're trading and managing risk with the right instrument that's connected, the right product that's connected to the risk you face. And that's what we're trying to provide people through Abaxx Exchange.
Yeah, that you guys have talked about this, and it makes a lot more sense now that we have the tariff war on the tape. But I mean, if you think of, you guys had me think about, I should say, you think about the supply chain of the commodity versus the financial supply chain, if you will.
Yeah.
You guys want to get into that in terms of the difference of the two, because you just hit on it briefly, but I think it's a critical assumption to make.
Yeah, absolutely. And in today's super interconnected world in both physical good flows and cross-border manufacturing components, we've all talked about that. The same thing goes in reverse with financing all of those movements, right? And so, yeah, I always like to say, commodity supply chain going one way is a financial supply chain going the other. And so you really, and the perfect example is after Russia's invasion of the Ukraine, when you saw that volatility spike in gas and the price spike in gas in Europe. And remember, commodities don't really get rationed by price in the short term. They get rationed by rising volatility. When the supply chain literally can't afford the working capital of shifts in their rolling stock or their inventory, right? So it's the volatility that breaks supply chains, not price. And so when we saw that example during that energy crisis in Europe, you saw theoretically a cargo of LNG going over $100 million, for a cargo, many multiples of the oil price. But that was theoretical, because how do you finance that? How do you how do you collateralize that? How do you hedge it, right? So yeah, theoretically someone's going to make all these profits, but you actually have to finance that thing to be able to deliver.
Yeah, it's interesting. I mean, like when you say it that way, volatility breaks supply chains, right?
Yeah.
Well, volatility also breaks asset allocations. I mean, if you get a breakout, and this is Hedgeye Macro 101, you get a trending breakout in volatility, you do not want to be long that commodity. I mean, and vice versa. You want to be long one that had epic volatility. Gas is a very good example.
Yep.
This, I couldn't have, well, I'm not in the, I guess I'm in the prediction business, but I don't make calls. I execute on the process, right? I didn't tell natural gas to appear the way that it did through its volatility attributes, while it did when crude was collapsing in what we would call quad 4, and natural gas was breaking out to the upside. In other words, its volatility was breaking down. Now that's first of all, that's a relatively new phenomena. Second of all, it's the only time I've ever had that on, right? Short oil, long gas, ever.
Right. Yep.
I mean, historically, if anything, the worst thing that I could ever trade, looking at my track record, was natural gas, because it had the highest volatility attributes.
Yeah.
So does that make sense in terms of your long-term view? If your long-term view is that gas is the new oil, I'm being very touristy.
I think as of like last Thursday, that's basically OPEC agrees with us. So
okay, so gas, let's just say, people need a summary, right? Like if gas is the new oil, then shouldn't the rate of change of volatility, on a long-term basis, really start to break down?
Yeah, I mean, so we're the only deliverable LNG price in the world, right? When you go to expiry, you get physical delivery. And right now, our price for landed LNG in Europe is $11.29. So an oil equivalent, you do the math, it's around $64 a barrel, right? Which is higher than Brent right now. It's much higher than WTI, because there's still that demand. And actually, Europe is super interesting because it kind of sits between an oversupplied North American energy complex and an undersupplied Asian, generally, and yet they're big importers. And they, so if you look at the BTU equivalent in Europe, it's very similar across lignite, coal, gas, oil. And you're seeing that, but again, it's still the gas that is really the key flexibility of their system. It's not oil. And for the power grids as well as a lot of the industrial use. So again, we think gas is now becoming kind of the new oil from a traded market.
Does this manifestation of LNG's price, or just gas's place in the discussion, does it? I mean, it starts with a lot of different things. It's never one thing, but does it start with this unbelievably bad infrastructure that the Europeans have for gas, transportation of gas, the price of gas, the whole 9 yards? Because a lot of people in the U.S. don't realize how well they have it off. I mean, in terms of the relative gas prices.
Yeah, absolutely. I mean, if you look today, natural gas Henry Hub in the U.S. is 3 and something. If you look just offshore in the Gulf Coast and that gas is on an LNG tanker liquefied, it's over $10.
Really?
So just that, I think the U.S. consumer doesn't realize the advantage we have in just terms of energy prices relative to Europe, relative to the rest of the world. And U.S. producers have a tremendous advantage. If you can be running your factory, running your petrochemicals at, a third of the price of what gas offshore is going for, that's a fantastic advantage. But what we really see, and part of why gas is replacing oil in our view, is that the market's globalizing, right? Before, gas always had to be in a pipeline.
Yep.
So, okay, you couldn't talk about gas on a global basis. You could talk about US natural gas, you could talk about European natural gas with TTF, you could talk about, LNG prices perhaps in Asia, but that was difficult. And so I think what we're seeing now is LNG is, that pipe that connects effectively the world together. And so you can start to talk about the energy price globally, natural gas being more representative of the energy costs people are facing. It's what's driving their electricity costs. It's what's driving increasing amounts of, the cost of energy to industry. So it's really replacing.
So then you slap the tariffs on it.
Yeah.
So how does that work? Like, what is the, $4 becomes $10 becomes what?
Yeah. So go back to one of your question before. It ties into both of these. Is so Europe is scrambling to build, and has for years now, regas capacity, pipeline capacity, infrastructure like the TTF market, so market infrastructure for gas. So that's definitely been under development. But what they've had a lack of is storage. The U.S. is, and that's what dampens the volatility, right? Is having that storage, where the U.S. and China have been building very deep, infrastructure for storage. So that again, volatility and storage are very, very linked, right? But back to the tariff point, it's I mean what we saw under the first Trump administration after the first round of tariffs with China is I think China went like almost a year, maybe over a year, without importing U.S. LNG. But then during the Biden administration, most of the funding, the new FIDs for all the new liquefaction capacity in the Gulf Coast, all came from, well, not all, but a decent portion of it was Chinese offtake. So now the Chinese firms are stuck with this offtake that has to be tariffed. So they're going to have to trade out of that. So now the complexity of the market's going to just be going totally crazy because you with your offtake you'll have, I think it's something like 10% breakage. I don't know the exactly, where you don't have to lift all of your offtake. But so they'll obviously try to minimize that. So they'll take less from the U.S. than they can, but then they're immediately going to have to sell it, which again adds complexities. Which was perfectly built for the market we built.
Now, look, let's just go back to that, not quickly, but I mean. Yep. So in Singapore, this would seem to me on my geopolitical risk map a pretty well situated place to be post what I affectionately call the PTP, the pump tariff plan. Was that? I mean, I think David said to me before this started. He said it was pretty good luck with this market move before we have this summit, right? These conversations. But, I mean, you picked Singapore, and now It's,
I mean, again, we did think through a lot of this 5-6 years ago. That's why we built it this way. I mean, obviously, the amount of BTUs that move through the Malacca Straits there, between east and west, that is the bottleneck. That's why, Singapore's always been that place. And previously, that role was Switzerland, right? And why was Switzerland so important? It was really taking the excess, capacity and commodities of Russia and moving it through Europe and the euro-dollar market all sort of, built in places like London and Switzerland for those reasons. We think that new center, both geopolitically and energy and finance, is Singapore, right? That's the east and west bridge, and we set up there for a reason, for sure.
And back to the tangential to that, the FX and collateral, the dynamics of FX, the currency you're executing in, collateral. China now devaluing their currency to lower levels than we've seen in a while. We get this, the currency war is coming on pretty hot all of a sudden without you even knowing that it was, without even knowing it didn't go away. How does that fit with collateral FX?
Yeah,
flows?
I mean, again, a lot of infrastructure to unpack there, but I think first off, I think it's super important to understand when political, or call it the central planners that you and I love so much, when they talk in papers and generalities, they often ignore things like energy. I think we've talked about this in the past where I think I was just shocked one time when I looked at the Fed's underlying inflation model, and the way they modeled oil was like an autoregressive, sort of moving average of front month oil that had nothing to do with a curve or a backwardation. Anyways, so it's pretty unbelievable how they forget about things like oil. So but even if you look at the papers around, tariffs worked last time, because the currency didn't made the adjustment. After the U.S. Slapped the tariffs on China, the currency made a lot of that adjustment. But that's fine when you're a pretty normalized environment. But when you are in a high energy volatility and there's not a lot of consumer demand and consumer flow of goods is one thing, you can't really stop importing energy, right? So the elasticity changes that whole dynamic. I mean, I go back to 2008. Where when oil prices went to $150 a barrel, and by the way, oil, that was actually specifically WTI, we had a shortage of light sweet crude. We weren't short oil, we were short a very specific product. But when every energy import into China is benchmarked against what spiked up to $150 a barrel, that changed their entire current account, capital account, currency. No longer can you roll over mortgages at Freddie and Fannie. The whole thing starts breaking down when you hit this terms of trade shocks with energy. So I think that's one part that when you're looking for risks, I don't think the academic papers do a very good job at all of covering those specific risks in commodities and energy.
Now, how about gold?
Yeah. So I have lots of views on lots of things. maybe
You're really handing it off here. Well, I mean, today's move in gold. I mean, first of all, just the imports of physical gold. If you look at the upside down of this tariff announcement, we could show you guys. We have a chart just to show. These are never when I see charts, because I stare at time series all the time that have ever on it. You should be paying attention, right? This is the biggest move ever. And then on a day like today, people are crying uncle on saying there's a dash for cash or there's a liquidity crisis. I mean, there are for certain high yield players and private equity players, but last I checked, the dollar's down pretty hard today and gold went vertical. Under prior liquidity, when you have a liquidity event, as you know, your gold gains tend to go away because you sell what you sell. You have to then sell your winners to get liquidity. So there's a lot there to unpack, but gold today, I mean, man, what an outlier.
Yeah, and I think there's the macro and the micro, right? I think what a lot of people were focused on, the past few weeks was this dislocation between the market in New York and the market in London, where the anticipation of the tariffs were saying we better get the gold into New York because that's where we need to cover our futures positions, and we don't want to be stuck having to potentially import it at a much higher percent. And just because of the way, the spot market being in London, the futures market being with the COMEX in New York, and them using different size bars, so a 400-ounce bar in London, a 100-ounce in New York, you had to basically route all that gold through Switzerland. So the gold has to go to Switzerland, get refined into a different size bar, end up in New York. So you get all these physical movements being driven by that anticipation. That anticipation, suddenly, oh, we're not going to put a tariff on gold, so now we've got a lot of gold in New York that otherwise wouldn't need to be there. But I think the bigger, macro point is what's a safe asset right now? And I think a lot of people are questioning that. And if you look, treasuries for a long time were the safe asset. The US dollar was considered safe. If you go into a world where that's not true, for a long time before the US dollar, gold was the currency of international trade. And in large parts of the world, it still is. And so I don't think we shift dramatically in the near term, but I think you have a lot of central banks, really since the Russian invasion of Ukraine and sanctions, a lot of central banks around the world said we should have a little bit more gold on our balance sheet because we could be cut out of the US system at some point in the future too. And I think now with the tariffs, it's saying, okay, the US might not be the most stable place for our assets. Maybe we don't want to hold as many assets. The capital account is the balancing for the current account and the trade. So, I think you're getting more of a bid in the market, longer term from central banks and investors around the world saying we'd like to have more gold in our portfolio.
The Germans are we want our gold back, give it back, and the U.S., from what I understand, can't deliver. Certainly there's a discussion there. How does that work? Post World War I, World War II, the winner gets all the gold and everybody else is sitting so all this storage that we have. versus the demand to get it back. Is there a way to think about that?
That's a good one. I guess I haven't thought about that one too deeply in terms of like the government controls of it, but I guess if if a government wants it back, you can put in the order and get it moved out of the New York Fed.
Right.
But
well, I think the problem is they can't.
It's kind of an interesting world where you say,
I mean, people are basically they're taking physical delivery on gold wherever they can.
yeah.
But if you can't get it back, you can't get it back. It creates more obvious problem where you can get it. So I mean, I don't know how this plays.
Well, I mean, again, and that's why we're launching a gold market in Singapore. Same reason. Thought about this years ago. We believe that we need a market that's linked, the spot market that people are trading over the counter. They want their physical gold in vault, not unallocated on a bank's balance sheet. So we're building a physical, very much like we did in the early days of BitGold, but this is more for an institutional setting. And we also have a futures market tied to that physical vault gold pool. So no more, London versus New York. All of it is in one place. You can do digital title transfer services, between each other immediately, not 4-day settlements, not flying it to Switzerland first to get it to the, get it to the New York. So, we're trying to simplify in a place like Switzerland, Switzerland. We're going to be doing more markets, but we're starting with Singapore, and Singapore will be. Where we have this integrated market.
So this, I mean, first of all, if you're like me, like you own physical gold, you invest in physical gold, you take delivery, but you can also have it. Like I'm going to have the McIlvaney guys here next. We're going to have the discussion, right? They're like, okay, you want to buy this amount of gold? Do you want us to mail it to you, or do you want us to keep it here? Is that? Are you saying you basically created the electronic version of that?
Yeah, exactly, but also with a futures curve and built for institutional investors.
Okay,
right.
So I can say because that does make it a blessing and a curse, right? Because I'm sitting there, I only want to buy and sell when I'm looking at my risk ranges, my vol setups, and that is not how that trades in the U.S. The physical piece, right?
Yeah.
It's like, can I get a quote? Okay, this is what we have. This is what we can use. It's just a very. It's almost like it's. I said when I first kind of interacted with it, it was almost like being on an old trading desk.
Yeah.
It's where like I bought a bond, sold a bond. It's like it's everything's in hand.
Yeah.
This is kind of old school still that market.
Yeah, absolutely, and it really has to do with the need for capital to hold that sort of gold inventory, right? So that's still very centered on the bullion banks. And then the access to the market as you go back to the next level of intermediaries that are actually serving middle market or retail customers through the supply chain of coins and blanks, and all of these things go through different supply chains just like anything else.
Right.
So when you see a gold price in London, that's the bullion bank price. But then all of these coin dealers, everybody else has got a hedge, to manage their supply chain and manage their capital. And again, that's in New York. So we've got this, this market that keeps evolving. That's not, and that's why these, coin prices you'll always see when when there's a crisis. Oh, we're out of gold eagles or whatever.
Yeah.
Right? It's because you have to manage an inventory that has to come from somewhere, right? And you have to finance that whole thing, which is again very capital intensive for something like gold. And so that's why we're trying to streamline the whole system, to be more efficient to like where these markets actually are, more local, not just this global start in London and then spread out from there. It should be, the supply chain should be serviced and risk managed, in local regions.
It makes practical sense. I mean, it's the way pretty much everything in life works. So why not? I mean, and that's the thing. It's like Wall Street, or in this case, London bullion market, whatever you're talking about. It's so archaic relative to most industries. Like Wall Street is on a huge lag.
Right.
It's like some people actually, if they're trying to criticize you, they'll say that you think too far into the future. I'm like, okay. You're a little stuck in the past.
I'm a mining engineer. If I'm going to build a business, the shortest time to build a mine is like 15 years. So you're messing with the wrong guy if you're thinking about duration. So,
what would you guys say? Just maybe last question on gold. What would you say to the people who always talk about the mismatch between paper gold, GLD, and what the implied valuation is versus the ability to deliver the physical on that?
You want to take that one?
Yeah. Look, I think it's over-reported. I mean, again, these market structure, like, sure, someone's hedging a position that, again, they're hedged on the wrong market, so there's going to be these mismatches and stuff like that. But these are temporary. I think in the broader scheme of things, like gold is now it's like a $20 trillion money stock, right? And a lot of it is, gold, bangles and bracelets and spread all over the world.
Yeah.
And then given enough time, that can be melted and delivered. And so there's no shortage of gold stock. It's just where is it at and what form is it at? So I'm not a big, conspiracy theorist with that. And I think the bullion banks generally manage their risk. They're not going to have this massive unallocated exposure. I think they're, particularly since 2008, and all of the different regulatory frameworks that have come in, I think the banks are pretty well, managing that risk, other than these very idiosyncratic ones that can, jump up at any time.
Yeah, I would just add on to that. Also, the experience of having a hard time getting a hold of gold is often, a little bit more of a U.S. European experience. If you're in Asia, it's much more integrated into people's day-to-day lives.
Yeah.
So I think the way we interact with the gold market in the West is a very different experience than the way people interact with the gold market in Asia, and what we do here might be evolving to more like what they do there.
Yeah, well, I mean, that would make some sense. Evolution a little bit, right?
Yeah. Well, one other point that's actually important, though, because what we're talking about with gold ties into exactly what we're happening in treasuries too, by the way, right? So, like, again, a treasury is not just this abstract thing. It's actually custodied somewhere. It's cleared somewhere, right? And there's been a lot of work between the SEC and the CFTC on, the infrastructure for moving treasuries. You obviously have a huge center in Europe. That's where, the custody, the frozen assets of Russia, those were custodied in Europe, right? So, and now Hong Kong is trying to obviously get those custodied in their control, right, in Chinese control, so they don't have the same issue. So again, there's a lot of plumbing under the hood that's actually not too dissimilar to what's happening in gold. And so, back to the flight to safety, I think it's also probably getting out of, some treasuries in Asia and moving into things like gold, which just has a little bit more control, even right down to the custody and legal situation.
Just flipping, because we've covered energy to a degree, gold. How about on the more, I guess some people would call them a little bit more obscure, like environmental commodities and trading on that front? Like, where are you guys at on that?
Yeah, so, as Josh said, since we launched the exchange last summer, we've got 9 contracts out trading in the market. We have the energy vertical, we're coming soon with gold, and we have environmental products. In this case, we've got carbon contracts, carbon offsets, and we also have battery metals. So we have a contract for nickel sulfate and a contract for lithium carbonate.
So very specific battery metals.
Very specific.
Not a basket.
No, and it's so important because, we talked a little bit about OPEC. I often think of, if you think about what's happening in the battery metal space, the dominance of Indonesia and China kind of puts OPEC to shame. Right, Indonesia is going to be producing 60 to 70% of the world's nickel.
Oh, great.
What's OPEC and oil? 10%. And the U.S. is a major producer of oil. So when you look at, what's happening there, and most of the contracts that were out before ours, they're really kind of based on a Chinese price. But what if you're need nickel outside of China? What are you benchmarking that to? When tariffs come into play, is that China price reflecting the price you're paying? Probably not. And so I think that's one of the areas that's, needs contracts that are dollar denominated, physically deliverable. We have contracts in lithium. You can deliver it in Singapore, in Rotterdam, or in Baltimore. So you get it where you're using it.
What would people have done before they saw that type of an innovation? Like, you're just trading nickel futures, right?
Yeah, it's what happened on the LME, a few years ago is what happened. So when the LME blew up and had to tear up nickel trades, what was really driving it was you had a large Chinese producer who was hedging, but they were hedging with the refined nickel that's really designed for the stainless steel market.
Really?
Yeah, and they were producing forms of nickel that go into batteries. So they couldn't cover their position with their physical because it didn't meet the spec that would go onto the LME. And so they were going to have to walk away. And so the LME tore up the trades. And so that's why it's so important. I think part of what Josh was so prescient about was you saw that these physical markets were moving away from what was traded on exchanges. And so that's going to be a problem. It's going to be a problem this year, next year, 5 years from now, who knows? But it's going to be a problem. And when Russia invaded Ukraine, it was a problem in the LNG market. couple years back with the LME, it was a problem for the nickel market. But you can see what the physical market needs, where that market's at, and we're producing the products to go to that. So now if you look at what happened with the LME, we have a nickel sulfate contract that's really designed for the forms of nickel that go into batteries.
It's great. I mean, like, people can argue all the people that I think people are arguing about tariffs and they don't even know what they're arguing about at this point. It's just a political view, right? I don't like pump, therefore, or I love pump, therefore. It's like, I call them pump, but anyway. But free trade has, tell me if you agree or disagree that free trade has allowed for freely trading commodities, historically, and okay, shit goes down in Indonesia or something's happening on the LME and the market figures out, okay, where to go next. Has that been like a free market response, or has that been much more like the mob running the thing? I don't know.
No, I think, if you look, the free trade of goods and services benefits or can benefit everyone.
Right.
And if you look at the amount of the world's population that's been lifted out of poverty, if you look at the wealth in the US, it's been driven by being able to trade. I mean, you kind of go back to Adam Smith, right? You have to, I love your green room, it's got so many fantastic books in it, but you go back to Wealth of Nations and it's, hey, each country specializes in what they're good at and trade, we can make each other better off. So, I think that's a piece of it. So we want to be able to trade and let the Chinese do what they're good at, let the American people do what they're good at.
Well, would you say that's where we were at up until
yes and no. I mean, there's
first week of April?
Like, you always get these sort of geopolitical, risks of concentration, right?
Yeah.
And countries, and geopolitically, you create champions to create that concentration risk, right? I go back to the tsunamis in Fukushima, disrupted the entire global supply chain because the Chinese really dominated this electrical components aspect of the copper supply chain, right? Because they don't have raw materials, so they want to very much be relevant by keeping some piece that's very strategic, right? So this is, and that played out across Asia in manufacturing, and so again, our view is to have global peace, which is ultimately the end goal, right? The end goal is free trade and lower violence everywhere, right? I mean, I believe that should be the end goal. Is you need to have that complexity and not have too many of these, like you said, mobs holding the cards or whatever, right?
Yeah.
Like, you want that diversification, whether it's it makes everything less risky, right?
Well,
Whether
in
it's
this
portfolio or commodity balances, right?
Yeah, in this case, you don't necessarily have the mob or a cartel. I mean, well, you have both across a lot of different things. But you have somebody like Indonesia is a good example with nickel. Okay, now isn't it just the math where we're going to tariff Indonesia on all nickel imports? I mean, therefore,
read the latest executive order.
Yeah, I know exactly. I know.
No, but when
it
you
is
have
a major problem,
because there's there's that stock to flow ratios or wherever the damn stuff is. I mean, when it's that concentrated in certain countries and it's not your own, therefore.
Right, like there's a reason people call different things critical minerals, right? And why we want to make sure that we have them. And I think China right now is coming out on the right side of that trade. If you look at where solar's been at the forefront, where renewables, electric vehicle sales kind of dominating that battery supply chain, it's been China. And I think they looked out at the world and said, we're energy poor relative to the US. We don't want to be dependent on the global marketplace. And I think now they're probably saying, yeah, we made the right bet. So, when you look around the world, I think what you find is countries need to look after their national security and they need to make sure they can provide for themselves. But also, there's a lot of gains to be made by trading with others.
Well, and if you can't, well, the Chinese, I mean, if we look at BYD's sales, electric vehicle sales versus Tesla, and you look at the market caps, it's like a joke, right? The difference. But they could be or should be the largest auto market in the world. China, are they not? I mean, in the future, at least. So you end up in a place where they're like, okay, I can't get energy, but I can get the batteries. I can have the deal with Indonesia. I can have isn't that the way that it's going to go? Overall, it's going to cost you a lot less to have a car in China than it will in Amsterdam or in
But again, that was very well thought out, right? That was exactly the model
That's what they wanted
to create, is that energy security. both for them and their trading partners, right? Where they're not reliant on OPEC, they're not reliant on U.S. trade routes, that sort of thing, right? So I think, and again, unfortunately, it's been an adversarial approach. It doesn't have to be, right? I mean, it shouldn't be, because all of these things work better if they are more integrated. But once you get those concentrations, that is where the risks, start to creep up.
Yeah, I mean, the free trade view would be, okay, all BYD can now just get shipped to the U.S. and now all these Americans get these cheap, actually better electric vehicles.
Yep.
I mean,
and it's green on all the other goals too, right?
Right, but that's not going to happen. I mean, it's not happening tomorrow. Let's just start with that. I mean, it's a really if you take the long-term view and you were to hold tariffs in its current stance, you will have that's what the market's telling you. You're going to have a very different world.
Exactly.
Like when you think about your business, like how much? I mean, most people have to answer that question, right? You built a business, you run a business. I'm the same way. For me, I'm not getting tariffed, but for most people, they have to make some decisions now. Do you have to make some decisions that are different than you would have thought?
I mean, again, I think we were very well planned for the world we're going into, and I think we've been thinking, like, again, I guess we have this engineer entrepreneur mindset, like, where's the problem, go fix it, that's going to be valuable, right? And commodity exchanges, like, we're in the volatility business, and it's a good business. I mean, the most profitable part of the entire financial service stack is the exchanges and the clearinghouses, highest margin businesses, right? It's a Google-like business where liquidity pools to the best products, and then it's kind of winner take all. So look, it's a great business model when you get it right. So that's why we have to be very well planned of how we're going to have better products, how we're going to do this. So. I think we're very set up for this world, but again, it's a bigger picture too, right? I mean, like, again, natural gas is a perfect example. As more capital goes in, because you have lower volatility, more predictability, at the end of the day, it does commodify and it lowers prices, right? So we're actually in a business that over a long term, we try to build ourselves out of our own business because we want lower volatility, but we make money when it's higher, right? So, but that's the engineering problem is, see that problem, debottleneck it, lower the volatility, hopefully create some better global trade. That's kind of what we do.
That's and back on carbon credits quickly, just because that's one where you can call hedge fund manager A and say, hey, look, I'm getting long carbon credits, and he'll be like, Somebody else, can you tell me what the hell that is? Like, I mean, you have some ETFs that are carbon credit ETFs. I mean, I could think of some of the Crane shares ones in particular. But like, where are we at on that?
Yeah, I mean, that's one where you really have to be in the specifics of what's the credit, what's the project that's producing the reductions or removals. So, just broad brush, you have compliance markets, which are probably getting a lot of attention today, given the administration's announcements about, pushing down on some of the emissions trading schemes like the one in California. So I think people there, are focused on what's happening with the California emissions trading scheme, which is a compliance regime set up by the state. The most well-known is the EU emissions trading scheme, which is a compliance scheme, a cap and trade scheme that Europe's been operating for quite some time. So you have those. You also have what are called voluntary carbon markets, where it was more corporations who were looking to make net zero commitments. And they were saying, we're going to try to decarbonize our supply chain as much as we can. To the extent we can't, we're going to finance projects around the world that will help offset some of our emissions. So whether it's keeping a forest from being, logged, or, investing in high-tech direct air capture technologies, those are other types of voluntary credits. So two very different markets. The compliance market's probably 10 times or more the size of the voluntary markets. And there's always been the question of, does this project actually offset this emission? And so, the voluntary carbon markets have often been a circular firing squad of, you can't have high enough integrity to satisfy everyone. So that's been a difficult thing for those markets. But the compliance markets, Europe has been operating, I think, going on 20 years now, and really kind of ratcheting down the amount of emissions, which puts a lot of their industry at a disadvantage. Not only are they paying much higher natural gas prices that we spoke about, but they have to meet the carbon allowances as well. So those markets, I think they're evolving. The U.S. honestly has never really been in a leadership position in those. So even though the president pulled us out of the Paris Agreement, is I believe pulling us out of the International Maritime Organization for emissions in vessels. Those are markets that the U.S. hasn't really had a leadership position on. But for me, ultimately, outside of the credit, not credit conversation, it really comes down to how do you get finance, how do you get investment in worthwhile projects that are protecting and helping the environment around the world. And the carbon credits have been the best way we've had to be able to get money to worthwhile projects.
That's a good summary, because I know nothing about that. What I do know, just to wrap up on this, what I do know is that I'm not from the future, but I do know what, if I can measure and map the price, the volume and the volatility of anything that ticks, then I know at least within a band of standard error that I can probably make some money on that more than I lose money on that. The problem with most commodities is that there are no ETFs. There used to be ETFs that weren't even ETFs, or ETNs that got shut down.
Exactly.
In what future state, like if you are from the future, can I like just start hitting some buttons and sending to Hedgeye Nation, like, look, we're buying lean hog futures, we're buying, like, as opposed, because that's really a big gap between what I could do when I was running a hedge fund institutionally and what I can communicate now using the same tools.
Yep. That is our goal. I think with financial technology and better ways to bring market access, right? I mean, again, like back to the gold example, it was an old boys club that slowly had different rings, so it was very hard to get to the center of the market. With technology and physically, we used to have floor trades and whatever. Like, you physically couldn't get to the center of the market, right? Now electronically, theoretically we can, but there's still a lot of old guard holding their position. They don't want transparency in the bond markets. They don't want transparency in aspects of the commodity markets, right? But our job as market operators and financial technology investors is to create that transparency and create that access. I do believe in a future. And by the way, like, even these ETNs and these ETFs of commodities are typically terrible products, particularly the ETNs, because they don't really tell you about what you're losing in the roll yield and all of this. And, and a lot of those designed, like, unfortunately, just like the incentives of the financial system, they were designed to be inefficient because someone was on the other side of the trade, right? And that's that's the reality of the actual incentives, not a theoretical whiteboard of like how these things should work, right? So it does take market operators that are really trying to have a goal of lowering the risk and creating these products. But like back to commodities, like our vision, through things like AI and distributed ledger, like, we shouldn't have to wrap a commodity future in a note on a bank desk to then be packaged into an equity with a prospectus that trades like all of the infrastructure to I call it taking a square peg and forcing it into a round security, right? Or a round token. Like we need to be able to keep the complexity of the underlying asset, whether it's a 200-page debenture or it's a very specific commodity with specific specs, and we need to be able to simplify that and get it to what people are actually trading. This is sort of the movement of decentralized finance, and that is a movement that's going to keep marching on. But people are blocking it, but it's going to go where it should go.
The decision is easy to make. I want to buy nickel.
Yeah.
Executing on that's not an easy exercise, right? So that's thank you for that, because we need somebody to disrupt the old wall, as we constantly call it, and somebody's got to do it. So thank you for doing that.
And that's the goal, right? But then, like I said, there's blockers. And by the way, like, since 2008, the amount of blockers are just being invented by the day to protect positions, right? So I think Mark Andreessen talked about this, and I don't think there's been any new bank licenses since 2008 or something like that, because the incumbents, why would have I? If I've got an FDIC and a Fed guarantee, like we saw it with all the regional banks, and if I've got the moral hazard and no one else does, you're going to get the concentration. Oh, yeah. Concentration in finance is just as risky as concentration in commodities, right? I mean, we need to knock down those blockers, and that's what we've been doing by having better products, better technology, and eventually you have to knock those incumbents out of their position. Yeah. And that's the goal, and that's what we're going to keep doing.
It's like watching the movie Cars. We got a blocker, and and inside of the transport they got trolls, and they're coming. It's just an amazing thing. You're doing something right when you're getting that kind of criticism, and it's very much needed. So thanks for making the time to come have a chat. Appreciate it.
Absolutely.
Thank you.
All right, these guys are the commodity guys. You can follow them. They're out there all the time on Twitter and whatnot. And I'll be back with the last conversation of the day.